You have been sold a 40-year lie. It is a comforting lie, a beautiful lie, and it is the very reason why millions of hardworking people will spend their final decades in a state of quiet financial terror. The lie is a word you hear every single day: retirement. We're taught from the moment we enter the workforce that the goal of life is to work tirelessly for 40 years, put a percentage of our income into a government-approved account, and then, at age 65, magically stop working and live off the pile of money we've accumulated. I am here to tell you that in 2026, the mathematical foundation of that dream is entirely broken. The rules of money have changed so drastically that the 20th century blueprint for retirement is now a blueprint for poverty. If your plan is to build a pile of cash and slowly bleed it dry over 20 or 30 years, you are playing a game of financial Russian roulette with inflation. The silent theft of purchasing power is accelerating. The cost of healthcare, housing, and basic survival is rising faster than the yield on traditional safe investments. You do not have a retirement plan, you have a hope strategy, and hope is a terrible financial advisor. Today, I am going to completely dismantle the illusion of traditional retirement. I am going to show you exactly why the math you were taught no longer works, but more importantly, I'm going to give you the blueprint for what you must do instead. We are going to pivot from the concept of retirement to the concept of sovereignty. We are going to stop trying to build a static pile of money, and we are going to start building a perpetual income machine. I have watched financial cycles repeat for over 8 decades. I have seen what survives and what gets wiped out. By the end of this video, you will have a 5-step protocol to bulletproof your future, whether you are 25 or 65. This is going to require you to unlearn almost everything Wall Street has taught you. Let us begin with the harsh mathematical reality of 2026. The illusion of the pile. The entire financial industry is built on selling you the idea of the pile. They tell you that if you can just hit $1 million or $2 million, you have won the game. You can retire. Let us look at the math of the pile. For decades, financial planners have used the 4% rule. The rule states that you can safely withdraw 4% of your portfolio every year, adjust it for inflation, and you will likely not run out of money for 30 years. If you have $1 million, 4% is $40,000 a year. Now look around you in 2026. What does $40,000 a year actually buy? In many parts of America and Britain, it barely covers property taxes, basic insurance, groceries, and utilities. It certainly does not cover catastrophic healthcare costs or long-term care. But the real danger is not just that the absolute number is too small. The real danger is the sequence of returns combined with the silent theft of inflation. Imagine you retire on a Monday, and on Tuesday, the stock market drops 25%. Which historically happens roughly once a decade. Your $1 million pile is now $750,000, but your cost of living hasn't dropped. You still need that $40,000 to survive, so you're forced to sell your assets at a massive loss just to buy groceries. You are permanently destroying your capital base. You are eating your seed crop. Once you eat the seed crop, it can never be planted again. It can never compound. At the same time, inflation is acting like an invisible moth in your wallet. If inflation runs at a true rate of 5%, your purchasing power is cut in half every 14 years. A $1 million pile that feels secure today will buy the equivalent of $500,000 worth of goods a little over a decade from now. When you combine a market downturn with high inflation, the pile is destroyed with terrifying speed. The people relying on the pile live in a constant state of anxiety. They check the stock market every morning in terror. They are afraid to spend money on a vacation because they might need it for a medical bill in 10 years. This is not freedom. This is just a different kind of slavery. You have traded a boss for a spreadsheet, and you are terrified of the spreadsheet. The pivot, the perpetual income machine. The wealthy do not operate this way. The wealthy do not build a pile of money with the intention of slowly spending it down until they die. The wealthy build machines. They build a perpetual income machine, a portfolio of productive assets that generates cash flow independently of their labor, and most importantly, independent of the principal. When I look at a business or an investment, I am not asking, how much can I sell this for in 10 years? I am asking, how much cash will this produce for me every year, forever? And will that cash increase faster than the rate of inflation? If you want a farm, you don't sell an acre of land every year to pay your bills until you have no farm left. That would be insane. You live off the crops. You sell the corn, you sell the wheat, and you keep the land. The land continues to produce year after year, generation after generation. Your financial portfolio must be treated exactly like a farm. In 2026, you must stop obsessing over your net worth and start obsessing over your cash flow. Net worth is an ego metric. Cash flow is a survival metric. You can have a net worth of $3 million because you live in a massively overvalued house in a major city, but if you have no cash flow, you are poor. You are just a poor person living in a museum. To escape the retirement trap, you must construct a portfolio that pays you to own it. Here is the exact 5-step blueprint to transition from the fragile pile mindset to the anti-fragile machine mindset. Step 1. Acquire assets with pricing power. To fight the silent theft of inflation, you must own assets that can fight back. A standard bond cannot fight back. A savings account cannot fight back. They are fixed. You must own productive assets that have pricing power. Pricing power is the ability of a business to raise its prices during inflationary periods without losing its customers. Think about the products you cannot live without: food, energy, basic consumer staples, essential technology. When the cost of raw materials goes up, companies like Coca-Cola, Procter & Gamble, or essential utility companies simply raise the price of their products. You, as the consumer, complain about it, but you still pay it. If you are just a consumer, inflation crushes you. But if you are a shareholder in those companies, inflation actually benefits you. The company's revenues go up, their nominal profits go up, and eventually, the dividends they pay you go up. Your goal is to assemble a portfolio of these extraordinary businesses. You don't need to find the next revolutionary tech startup. You need to find the boring, essential businesses that have increased their cash payouts to shareholders for 25, 30, or 50 consecutive years. These are the engines of your perpetual income machine. They give you a raise every single year, completely passively. Step 2. The yield on cost miracle. This is a concept that Wall Street rarely talks about because it requires patience, and Wall Street makes money on impatience. When you buy a dividend-paying stock, let's say it pays a 3% yield, that seems small. The amateur investor says, 3% is nothing. I want a stock that will double in 6 months. So they go gamble and lose their money. The wealthy investor looks at the 3% and asks, will it grow? If you buy a high-quality business, they don't just pay a dividend, they increase the dividend every year. If they increase their payout by 7% a year, your income doubles every 10 years without you investing another dime. Let's say you buy a stock for $100 and it pays $3 a year. That is a 3% yield. But over the next decade, the company grows and doubles its dividend to $6 a year. Because your original cost was only $100, your yield on cost is now 6%. Hold it another decade and it might be 12%. I have holdings in Berkshire Hathaway where our yield on cost is over 50%. We receive more in cash dividends every 2 years than we paid for the entire investment decades ago. This is how you beat inflation. You buy assets whose cash flow grows exponentially while your initial cost remains fixed in the past. Your perpetual income machine gets stronger every single year you leave it alone. Step 3. The 3-year cash shield. I told you earlier about the terror of having to sell your assets during a market crash. The perpetual income machine is designed so you never have to do that. But what happens if companies cut their dividends during a massive global recession? What happens if rental income dries up temporarily? You must have a shield. Before you ever declare yourself financially independent, you must calculate your bare-bones living expenses for 1 year. Then you multiply that number by 3. You keep 3 years' worth of living expenses entirely out of the marketplace. You keep it in short-term government treasury bills or a high-yield cash account. It is entirely liquid. It is immune to market crashes.
Why 3 years? Because historically, the vast majority of bear markets and recessions recover their previous highs within 36 months. If the market drops 40% in 2026, you do not panic. You do not check your portfolio. You do not sell a single share of your great businesses. You simply live off your cash shield. You let the storm rage outside while you are safe inside the fortress. By the time your 3 years of cash are depleted, the market has almost certainly recovered, the businesses are generating record cash again, and your machine is intact. The cash shield is not an investment. It is the psychological armor that allows you to be a rational investor when everyone else is acting like a terrified animal. Step 4. The eradication of frictional costs. A machine only runs efficiently if it is well lubricated and free of friction. In the financial world, friction is spelled FEES and DEBT. You cannot build a perpetual income machine if you are carrying consumer debt. If your investments are generating 8% a year, but you are paying 18% on a credit card or a high-interest auto loan, your machine is running in reverse. You are building wealth for the bank, not for yourself. You must ruthlessly eradicate bad debt before you can scale your freedom. The second friction is Wall Street fees. If you have an advisor charging you 1.5% of your assets every year to manage your money, they are robbing you blind. 1.5% sounds small, but over 30 years it will consume a third of your total wealth. You do not need a complex strategy. You do not need hedge funds. You need low-cost index funds and direct ownership of high-quality businesses. Keep your costs as close to zero as humanly possible. Every dollar you save in fees is a dollar that goes into your pocket, permanently compounding for the rest of your life. Step 5. The redefinition of work. This is the most important step, and it is entirely psychological. The biggest lie of the traditional retirement model is that the ultimate goal of life is to do absolutely nothing, to sit on a beach, play golf for 30 years, and slowly decay. I am in my 90s and I tap dance to work every day. Why? Because human beings are not designed for perpetual leisure. We are designed to solve problems. We are designed to be useful. When you remove purpose from a person's life, their mind and body deteriorate with terrifying speed. The goal of the perpetual income machine is not so you can quit working. The goal is to give you total autonomy over how you work, when you work, and who you work with. Financial independence means you have the power of no. You can say no to a toxic boss. You can say no to an unethical client. You can say no to a commute that drains your soul. But it also means you have the power of yes. You can say yes to starting a business you are passionate about, even if it doesn't make money for 3 years. You can say yes to mentoring the next generation. You can say yes to problems that actually matter to you. Do not run away from work. Run away from forced labor. The wealthiest and happiest people I know never truly retire. They simply pivot from working for survival to working for legacy, meaning, and joy. Conclusion: the choice is yours. In 2026, the economic divide is no longer between the rich and the poor. It is between the owners and the dependents. If you are relying on a government pension, a fragile 401k pile, or a single salary to survive, you are a dependent. You are completely at the mercy of inflation, market crashes, and political whims. If you build a perpetual income machine, you become an owner. You achieve sovereignty. You build a wall around your family that economic chaos cannot breach. This path requires incredible discipline. It requires you to spend less than you earn by a significant margin. It requires you to ignore the flashy get-rich-quick schemes that are peddled on social media. It requires you to do the boring, rational things day after day, year after year. But I promise you, the math works. The physics of compounding are absolute. Stop trying to build a pile of money to bleed dry. Start buying the farm. Start collecting the crops. Build the machine. The traditional retirement is a scam. True freedom is a system. Subscribe to this channel. We are going to continue building this machine together. We are going to focus on the reality of cash flow, the mathematics of value, and the philosophy of true independence. The rules have changed. It is time you changed with them. Start building your machine today.